Hello and welcome. Today, we're diving into a really big question in the world of trading. Is technical analysis a science with hard and fast rules, or is it something else entirely? We're going to explore why it might be better to think of it as a practiced art form.
At the core of all this is one single, tantalizing question. Can looking at these lines and squiggles on a price chart actually give us a peek into the future? It's the dream, right? And it's the fundamental promise of technical analysis.
And that's really the appeal, isn't it? I mean, the market often feels like total chaos. Technical analysis hands you a set of tools to try and find some order in that madness, to spot patterns in what millions of traders are doing. But that very behavior creates a really strange paradox.
And that brings us to this fascinating idea, the self-fulfilling prophecy. See, a technical signal can work for one simple reason. Enough people believe it's going to work. When thousands of traders see the same pattern and all act on it, their combined buying or selling actually pushes the price where the pattern predicted it would go. The prophecy comes true because people acted on it.
But here's the catch. That same prophecy can end up destroying itself. It's a cycle. First, a clear signal works, so more and more people start using it. Then, traders get smart. They start trying to get in before the signal actually triggers to get a better price. But all this front-running distorts the signal. It makes it less reliable. Eventually, it stops working, people abandon it, and the whole cycle waits to start over with a new pattern. The pattern's own popularity becomes its downfall.
Okay, so the self-fulfilling prophecy is one thing, but there's a much bigger challenge, and this is what really pushes technical analysis from the world of science into the world of art. And it's this. Any single chart can tell a whole bunch of different stories, all at the same time. Let's start right here. Think of this as our source of truth. It's a simple, clean price chart. No lines, no indicators, nothing. It's just the raw data, a blank canvas waiting for an analyst, or maybe an artist, to come along and interpret it.
So, analyst number one steps up to the canvas. They decide to connect the dots, right? They draw some trend lines, and they see a story of the market's general flow, these broad upward and downward movements. It's a totally classic and valid way to look at it.
But then another analyst looks at the exact same chart and says, nah, I'm not interested in those trend lines. Instead, they overlay moving averages. They're telling a totally different story about momentum, about where the price might find a floor of support or hit a ceiling of resistance.
And then, along comes analyst number three. They don't see broad flows or smoothed out lines. They see shapes. They spot classic patterns like triangles, channels, maybe even that famous head and shoulders. And to them, these shapes are forecasting very specific short-term moves, either up or down.
And just to make it interesting, a fourth analyst ignores all of that. They're focused on what's called mean reversion. They see the price like a rubber band that's been stretched way too far from its average and is just about to snap back. So, we have four different analysts, four very different stories, all from the exact same chart. And that, of course, leads us to the million-dollar question. If all of these interpretations are based on perfectly valid technical ideas, which one is right? Which story do you bet your money on? This is the fundamental dilemma that every technical analyst faces every single day. And if you can believe it, the problem gets even trickier. It's not just that there are different stories out there, it's that you can often find completely opposite stories on the same chart at the same time. For just about every argument that the market's going up, you can find one that says it's going down.
Just look at this. Right here, we have what's called an ascending triangle. That is a classic bullish signal that suggests the price is about to break out to the upside. But it's happening inside a much larger head and shoulders pattern, which is a textbook bearish signal. So is the market going up or down? The chart is literally screaming two opposite things at once.
So how does an analyst make sense of this? Well, sometimes these conflicts are just confusing, like you see on the left, where different indicators are flashing buy and sell all at once. But other times, an experienced analyst sees nuance. On the right, you might have a short-term indicator saying the market's overbought, while a long-term one says it's oversold. That might not be a conflict, but an opportunity, a chance to buy into a small dip within a much bigger uptrend.
And this is where our own human psychology really messes things up. It's something called selective perception. We tend to see what we want to see. So if an analyst is already feeling bullish, their brain might subconsciously just ignore the two bearish signals on this chart and latch on to the one bullish signal that confirms what they were already thinking.
This subjectivity creeps into everything. Even the most basic things. You'd think drawing a simple trend line would be objective, right? Just connect the dots. But which dots? Look here, both of these trend lines are perfectly valid ways to draw the trend. Neither one is wrong.
So if the price breaks below the line, which break matters? The one that crosses line A or the one that crosses line B? The real signal depends entirely on which subjective line the analyst decided to draw in the first place.
And that one simple choice opens up a floodgate of other questions that have no right or wrong answers, just judgment calls. How far does the price have to break before you act? Do you jump in right away or wait for more confirmation? How can you be sure it's not a fakeout? This is all based on experience and intuition, not a formula.
Okay, so now it's your turn to be the analyst. Take a good look at this chart. Based on what we've just talked about, what do you see? Go on, you can even pause for a moment and see what jumps out at you.
All right, ready for the reveal? On that exact same chart, a more practiced eye might spot all of this. A rising wedge, a couple of downtrending channels, a symmetrical triangle, and even a bullish inverted head and shoulders pattern. It's the same canvas, but with experience, you start to see a lot more detail.
And this really brings us to the key takeaway here. Yeah, technical analysis is subjective, but that's not a weakness, it's the whole point. As an analyst gets more practice, as they spend more time just looking at charts, their pattern recognition skills get sharper. The process becomes less about guesswork and more about skilled, nuanced interpretation. So in the end, technical analysis isn't some magic formula for printing money. It's about training your eye to see the hidden structure within the market's apparent chaos. And what you find is that a simple price chart, forged by human emotions like fear and greed, can reveal an underlying order and symmetry that is, in its own way, as compelling and beautiful as any work of art.
Which leaves us with one last question to chew on. Is the technical analyst simply discovering patterns that are already there, hidden in the data? Or are they imposing patterns from their own mind onto random noise, which then only become real because they and others act on them? Maybe the answer, just like with a great piece of art, is ultimately in the eye of the beholder.